36 years, but with 5 different companies. So the plan that I'm in now, I could not use that money because I'm an active participant. But one of my old companies, I could take that qualified money and do an IRA rollover into this plan and it would work. Right? So the first requirement is we can use qualified money, but you cannot be an active participant in the plan. So in this example, what we're going to do is we're going to move $125,000 of his IRA funds. And if we use an hourglass for a specific reason. This is probably our most complicated product. The illustrations tend to be someplace between 10 to 15 pages. But I think if you understand the hourglass concept, you should figure out how this works. The hourglass is pretty simple, right? The minute you turn it upside down, all of the sand is on the top, nothing's on the bottom, but immediately when you turn it upside down, the sand starts moving from the top to the bottom. And it moves at a level rate. It doesn't go fast and then slow down and then speed up again. It's a level rate. At some point, the sand is probably evenly distributed between the top and the bottom, and by the end, there's nothing on the top. It's all on the bottom. Is that pretty much it? That's pretty much it. All right. So we agree on that. So what's going to happen here is we're going to take the IRA and we're going to move it into the top half, which is an IRA. It's still that's another annuity. It's qualified money still. All we did was an IRA rollover. Immediately, we start taking money from the top to the bottom. It's a percentage that does not change. It's a little over 6.5%. All right? So in this case, about $8,000. Now when we moved that $8,000, we took the first one out immediately, and then we're going to do it every anniversary for the next 19 years. So internally, we're funding a 20-pay life. They don't have to ask us to do this. We do it internally automatically. All right? So they have $125,000. Immediately, we take the first $8,000 out. And where is that going? That's going to the bottom, which is the life insurance. And the life insurance, now in this case, we can do this on an individual or a couple. This was his IRA, but he's married. So we're going to do it as a couple. So we're going to take that $8,000 and that's going to buy life insurance on these 2 individuals. Now, we're also going to go up here on the top, and on the IRA, when it comes to us, we're going to add her as an eligible insured, which means she has access to long-term care benefits but no control over the cash. He still is the owner. So we're going to make her an eligible insured. So now we have joint coverage, and we also make her the primary beneficiary on the annuity. So if he dies first, she can complete this plan. If he dies first, she can continue it. If she dies first, moot point. It'll self-complete. So we're going to take $8,000 out. And that buys the life insurance down here. Now, since we took $8,000 out, there's not 125 up there, there's 117. So immediately what's happened is, we started with 125,000 of qualified funds. Now, we've got a big chunk on the top, but we created this amount on the bottom as well. We get to add them together. When you add those together, there's your 250,000. Now you can take 2% of that 250,000, 5,000 a month for either of them for long-term care. You go through the base policy first and then the rider second. And the rider can be unlimited lifetime benefits. Now what I tell people about this qualified deal here is 4 things happen right up front. Number 1, we're leveraging your money day 1 for long-term care or death. If you left it in the IRA, the $125,000, and you're in a car accident and you and your wife die, the kids get the $125,000, but it's all taxable. If that same event had taken place in year 1 here, the kids would get $250,000. Everything above the line, the $117,000 in the IRA, that's still taxable. Everything below the line, $133,000, that's income tax free. So in year 1, a little over half of this is tax free. We've leveraged it, and a little over half of it's tax free. By the 10th year, 2/3 of it's tax-free. By the 20th year, it's all tax-free. So step 1 is we leverage this money. We leverage this account if you need it for long-term care or death. Step 2 is we added long-term care. See, they're very unlikely to use their $125,000 to pay for their long-term care because everything they pull out is 100% taxable. And then you're going to go through it dollar for dollar. You're going to burn through $125,000 really quickly. But using this strategy, we're leveraging it to $250,000. So now it's available for long-term care, and even though the IRA was on 1 person, for married couples only, we can make it joint coverage. Now, Asset Care 1 was liquid funds. I said any 2 people with an insurable interest. For qualified money, it has to be a spouse if you want to do joint coverage. That's the only way they'll do it. Because there's rules about continuing an IRA. So we turned, number one, we leveraged it. Number two, we added long-term care. Number three, the government wants their little piece of the pie. So right here, every year, when we take out this $8,000, we send them a 1099. This qualifies as their required minimum distribution. Now, why is that so important this year? What did we say earlier? The oldest baby boomers are turning 70 this year. If they haven't started taking their money out, they have to. Why not move it? If you don't need it all for an income, why not move a chunk in such a way that we'll take care of your distribution and we'll leverage it and add long-term care benefits? Number four, if they don't need it for themselves, now it's estate planning, because who's going to get it when two of them are gone? Their heirs, they'll name the beneficiaries. So this is Asset Care 3. Now Asset Care 3, the case size usually jumps. We see a lot of Asset Care 1s where people move to CD that was 175, 100, 150,000. Asset Care 3, it's not unusual to see people have $1 million or more in a qualified account, and they'll say, well, 2/3, 3/4, it's going to go to provide an income. But that still leaves a substantial block that could be repositioned. It's not unusual at all to see 200, 300, or 400,000 going into an Asset Care 3. And why do they like it? Because once again, something is always paid out. Now here there's a different age requirement. It's 59 and a half to 80 because we don't want to have to deal with 10% penalties if they're too young. It could be done on an individual or the package joint life basis, but as we already mentioned, if it's the joint life, it has to be your spouse. Once again, it's got the guaranteed cash value, and it's got the guaranteed death benefit, and it's got the guaranteed principal. So that illustration that was pointed out, that was handed out, you've got the $125,000 showing $250,000 of death benefit over 50 months. You've got $5,000 a month until the death benefit's exhausted. Now, what we found with Asset Care 3, it helps dramatically if they can see this as a tool. So we put together this little sales tool. It's the hourglass. We put together the hourglass sales tool, and all we've done here.
So is $8,000 taken out every year?
Yep. So the first question is that $8,000 in the middle, does that come out every year? Absolutely. For how many years total? 20.
So does the price at the top, does that go down every year as well?
Yep. So these are all good questions. So is this amount on the top going down? Think about the hourglass. What happens? At the end of 20 years, how much should be left on the top? 0. And then this is starting with a smaller amount, but what happens every year it's going to go up, and at the end of 20 years, everything is on the bottom. So so death benefit, by the end of 20 years, nothing's on the top, it's all on the bottom. So everything would be income tax free, whether it's a long-term care claim or a death benefit. So yeah.
Is the 133,000, is that based on the age? I mean, how did you arrive at that?
Yeah.
Life?
That's based on a husband and wife, both age 62, this illustration shows.
Okay.
Up on the top.
Yeah.
And so, and just like before, if they said $5,000 is not enough monthly benefit, instead of going to 50 months, what would our option be? We could do 33 months and have a larger monthly benefit come out, because it's coming out in a shorter time, but then they would pay more for their lifetime ride.
Underwriting?
Underwriting, we're going to save to the end, but it has to be a major health problem for them not to qualify.
On the bottom, 133 is growing.
Yep. So if you look at the handout on the sales tool, they tried to show you that up front, year 1, you still have a lot of it in the IRA still. And then by year 10, it's split pretty well even. By year 20, it's all on the bottom. You can take the numbers right off of this illustration and fill in one of these worksheets so that you have a one-page example to show somebody. Look, if you die or need long-term care in year 10, you're going to have your total amount of available for long-term care is X, and it's going to be someplace between around 250,000, of which now you're down to about 2/3 of it will be income tax free. You'll see in here on the illustrations. Flip to your second page. On your second page, the first ledger that they're showing is the annuity. Look on the left-hand side near the top, it says this is the annuity policy. So that's the top of the hourglass. So they're taking out the 20 level payments of $8,000. Now look at not the last column, surrender value, that's if you quit. If you die or need long-term care, we use the second column from the end, the cash value. At the end of the first year, there's $120,348 in the annuity. 120,348. By the 10th year, what's left in the annuity? 71,670. So that would go. You're filling in the top part of the chart. So 71,670 goes under year 10 on the annuity. By year 20, what's left in the annuity? 0. Now flip it over one page. Look at that upper left-hand corner. Now you're showing the life policy. The life policy. So every time we get another payment of $81.57, and you could put the $81.57 out here in front, okay? Every time we get another payment of $81.57, the death benefit long-term care balance goes up. In year 1, it says it's $133,819. Go to year 10. What are we showing for year 10?
176.
176, 625. And then finally in year 20, 239,651. Now go one last time. They show you one more ledger, and this is the total. This is the total, putting it together. Now, where does the total go in here? Underneath the hourglass. If you added up the two separate numbers, the annuity and the life insurance, in year 1, you'll have 254,167. 254,167. By year 10, it's 248,296. And by year 20, it's 239,651. So now you've got one page. So this is our most complicated product, but now you've got one page. Why are we doing this? Because by moving that $125,000 IRA, which you said you probably wouldn't use for long-term care because everything you pull out is 100% taxable, by moving it over here, year 1, it's worth over $250,000 if you die or need long-term care. Now, let's talk about that. If the two of you die in this first year, that $250,000, everything above the line, 120, is taxable. Everything below the line, 133,000, is tax-free. By the 10th year, look at this. 2/3 or 3/4 of it's tax-free. By the 20th year, it's all tax-free. So the longer out you go, more and more of it, eventually all of it, is tax-free, whether you die or need it for care. So this strategy makes sense because they've got all this qualified dollars. They don't have liquid money anymore that they can move in some cases. They've already moved all their CDs. This allows them to move some of their qualified money into a product where now they both have long-term care. This is just the base. This is just the base. What else can they do after the base? They can put that lifetime rider on. So if we would go one page back after the last ledger page, there it talks about the rider, and the first page shows the rider's non-cancelable. The next page shows the cost for the rider. So here, once again, as a lump sum or annual payments. And most of these turn out to be annual payments. So if you go to the bottom and you take a look, this couple is 62 years old. They can have lifetime coverage with 3% compound inflation, and the total premium is $2,800 a year, guaranteed never to go up. It's not $2,800 each, it's one payment of $2,800 that gives them both unlimited lifetime benefits that are starting at $5,000 a month and continuing to go up with 3% compound inflation. Now when they look at traditional long-term care, it's always more than that with no rate guarantee. So they're going to say, hey, if it sounds too good to be true, it usually is. Now you have to explain it. It's not too good to be true, it's just too good to be free. The reason the cost is low and guaranteed not to go up is they can't touch $1 of the rider. They can't touch any of this until they go through what first? The base. Does that make sense? That's why these products are so strong. That's why people like them. Because you have the catastrophic coverage, and it makes sense. We're not worried about how we're going to pay for it because you know you have to go through this first before you can even get to this. That's qualified money.
A couple quick questions.
Okay.
One is, somebody takes this out at 79. And for sure, the $8,000 is above the RMD, assuming they have no other IRA.
See, now, we have to take out, it's about 6.5%. So whatever that dollar amount is, we have to take that amount out because the actuarials determine how much do we need to support that 20-pay life. So that as the annuity is gone, then now this is fully funded.
So if I have multiple IRAs, and every year I take the 1231 balance of those IRAs and then multiply it by the factor that they have to take, then decide which bucket I have to take.
You-
By 79, you're getting kind of close, you
You-
gotta take some on everything.
You can't choose where it's gonna come from. We have to take it from the IRA that we rolled over, but here's the key, here's the fun part.
But will you then be able to tell me how much is left in that, the upper part of the glass, so that I can calculate the need for the multiple IRAs?
So what we're pulling out in the middle can never change. All right, it's always gonna be a level amount. So what's happened is initially, if you look at all of their qualified money, on this amount of funds, it's probably excess, it's more, which means you can take less from something else, right?
Exactly.
And then down the road, what you're gonna see is this number's not gonna change. So now the amount for the other side,
But you'll be able to give me.
a factor value.
You'll be able to give me the upper part of the glass. So-
Yeah, that's all, you'll have the illustration.
But the companies that have the other IRAs can also calculate it for you. So you can ask them to calculate what the RMD is, and if the total is more than 8,000, then you can tell
Take
the
it
other
from the-
companies where you want the
Yeah,
RMD to
exactly.
come from. So you don't have, your customer doesn't have to calculate anything, the
Right.
companies will do it for you.
So that's qualified money, and like I said, the K size jumps dramatically, and there's no competition right now. There's no other company right now that is using qualified money into one of these comparable programs. And like I said, this has already been looked at with the DOL, and this is one of the exempt products. This is a huge product for us. There's only one life product I wanted to talk about yet before we went into the annuities, which is much shorter. Do you want to take a short break first?
Yes.
Sure, we can take a quick break. I'll fill the coffee pot here.
Can I ask you one more question? So, you said, you can't take it out.
Yeah.
Got some cases they don't want, but there's cases.
We know what we're saying. Our company, simplify things, we're gonna put our
My example that I use is I've got one guy that
No.
has a
Yes. Medical.
that is